Good morning, everyone. It's April 22, 2017. Thank you for attending part 2 of the Ichimoku Trading Strategies webinar. I'm Charmaine. We will be together for the next few hours. The session is recorded. I will provide you with a link, the same as the last time, as well as the notes. So let's review last week's lessons. Ichimoku is a one-glance equilibrium chart because it lets users determine the medium-term and short-term bias of a position instantly at one glance. It also shows the supports and resistances. Ichimoku is used for trending markets. This Euro FX USD chart shows a trending market. Ichimoku lets you find the bias of any position with a quick glance. This chart shows that the currency pair is bullish on the 4-hour time frame. The trend changes swiftly from an uptrend, where all Ichimoku elements are above the Kumho, to a downtrend, where Ichimoku elements are below the Kumho, including the price. Once again, we see a shift in sentiment from downtrend to uptrend. So it is easy to see the impending shift in bias using Kumho twists. As you know, Kumho twists happen 26 periods ahead of any change in trend. Therefore, Ichimoku practitioners, just like you and me, are warned of this change ahead of time so that we could prepare for this. In an uptrend, once price drops below the Kumho, you have a Kumho breakout to the downside. This break below the Kumho is a strong signal of changing bias from uptrend to downtrend. Now, in a downtrend, once price goes above the Kumho, you have a Kumho breakout to the upside. This break above the Kumho is a strong signal of changing bias from downtrend to uptrend. Ichimoku is an effective tool for use in trending markets because the signals are very clear. However, it must not be used for ranging markets because it will create many false signals. This USD-CAD currency pair shows some sideways movement within its chart. Here are the two areas where price traded within a range. Could you use Ichimoku to profit within this range? The answer is no. Ichimoku is not effective for use in ranging markets. You would find that the Ichimoku elements within these ranges are frequency changing signals. You would find that the Ichimoku elements within these ranges are frequently changing signals. For example, in trading range 1, price crossed above and below the Kijun-sen at least 5 times within this short time frame. The Tenkan-sen also crossed above and below the Kijun-sen with the price. In addition, there were many Kumho twists within a very small price range. If you read into this chart more closely and you are an Ichimoku user, there's one clue that this market was going to be stuck in a range for a period of time. That clue is the Chico Span. The Chico Span had been moving sideways. If you were trading using Ichimoku within this range, you are more likely to lose money than earn money because the signals are very confusing. In addition, since the price range is very small, your profit potential will not be worth the trouble. Now, after all the false twists and crossovers, the Chico Span finally breaks out of the range. and it was able to make higher highs. This is the confirmation of a breakout and a new incoming trend. This uptrend is where we could apply the Ichimoku trading strategies. As long as price is above the Kijun Sen, the uptrend is intact and the trend is bullish. But once we get into the range once again, avoid using Ichimoku as a trading strategy. Now let's review the 6 components of Ichimoku. The Tenkan-sen is the pink line. It is also known as the conversion line or the turning line. It tells you the short-term bias of the market. Now, if price is above the Tenkan-sen, it is bullish and has strong momentum. If price is below the Tenkan-sen, the short-term bias is bearish. It is computed by adding the high and the low of the last 9 days and dividing that by 2. So it shows you the midpoint of the highest high and the lowest low for the past 9 days. Now here are examples of some securities that are trading above the Tenkan-sen. PNX, the price of PNX tried to break below the Tenkan-sen line for the past few days, but it closed the week above the Tenkan-sen line. So the momentum for PNX is still intact. Bloom also tried to break below the Tenkan-sen line this week, but it closed the week above the Tenkan-sen line. And this means that Bloom still has strong momentum. Yellow Corporation broke below the Tenkan-sen line, and the direction of the Tenkan-sen line started to shift downward. However, it was able to end the week above the Tenkan-sen line. So because price is still above this line, this means that the momentum is still intact. To go also closed the week above the Tenkan-sen line. TEL broke below the Tenkan-sen line this week, but it was able to bounce off the Kijun-sen line. We will see next week whether it will be able to regain its momentum last week. JG Summit also ended the week strongly above the Tenkan-sen line. Now let's talk about the Kijun-sen line. The Kijun-sen is a blue line. It is also known as the reference line, or the standard line, or the baseline. The most important function of the Kijun-sen line is as an equilibrium line. This means that if prices are too high, it will tend to return back to the Kijun-sen line to restore equilibrium. If prices are too low, it will have to bounce back to restore equilibrium as well. So the Kijun-sen tells you the medium-term bias. It also tells you the supports and resistances. Price dropped too low and too far away from the Kijun-sen line that it has to bounce back to restore equilibrium. This immediately makes the Kijun-sen line as the first resistance line. Notice that when price bounced from this low up to the Kijun-sen line, prices hesitated at the Kijun-sen because this serves as the first resistance line. Price was able to break above the Kijun-sen line, and due to strong momentum, the Tenkan-sen crossed above the Kijun-sen line. The price of CHP ended the week above the Kijun-sen line. Now let's look at another example. Notice that EEI was also on a strong downtrend, and the Kijun-sen served as its strong resistance. When price crossed above the Kijun-sen line, the Kijun-sen became support. However, the strong momentum upward caused disequilibrium in the market because prices were too far away from the equilibrium line. You can see this huge space right here. This shows the amount of disequilibrium in the market. Therefore, price has to consolidate sideways or downwards and restore equilibrium by reattaching to the Kijun-sen line. So price is consolidated in this area. And then once again, prices broke above the Kijun-sen line. It made a strong move again. And now after the strong move, prices moved far away from the Kijun-sen line once again and now has to consolidate in order to restore equilibrium again. Now you could use the Kijun-sen line as your trail stop. Once price drops below the Kijun-sen line, you can cut your losses or take profits. And then once price goes above the Kijun-sen line once again, buy the security and hold it as long as it's above the Kijun-sen line. Now the Chico Span is also known as the lagging line because it is behind current prices by 26 days. We count from today's candlestick 26 days back. That we find the Chico Span. The Chico Span provides ranges of supports and resistances. AGI had been trading within a range. This range is shown by the Chico Span bottoms and the Chico Span tops. Now Chico Span at this point was also trading below prices. Now at this point, Chico Span was able to break above prices. It resulted in a strong move upward. Prices were also able to break above its previous highs. At this point, there's a price breakout. This was the previous high. But note that the Chico Span was able to warn you of the breakout starting from this point. So you would have been able to buy at this point before other breakout traders even started buying. Here's another example. MAC. This is the chart of MAC. At this point, prices had been trading within a range. The Chico Span was also trading inside the prices. This shows a sideways movement. But in this area, the Chico Span was able to break above prices, and this started the uptrend for MAC. Prices moved upward, the Chico Span moved upward. It was a strong uptrend because it was a strong uptrend and prices made 3 pulls in the process. 1, 2, 3. At the same time, the Chico Span also shows a strong trend upward. So as long as the Chico Span is above the price, it will remain bullish. Currently, the Chico Span is still above the price. However, if the Chico Span goes inside the price range, price will also move sideways. If Chico Span breaks below the price, if Chico Span breaks below here, then the sentiment would have turned from bullish to bearish. The next component is the Senkou Span A. This is also known as the leading or preceding line 1. It is the average of the Tenkan Sen and the Kijun Sen for the past 26 periods. This is plotted 26 periods forward. Now the Senkou Span B is also known as the leading line 2. It is the average of the Tenkan Sen and Kijun Sen for the past 52 periods, plotted 26 periods forward. The Kumho is the shaded area between Senkou Span A and B. The Kumho, or the cloud, is the foundation of the Ichimoku. The Kumho, or the cloud, is the foundation of the Ichimoku Kinko charting system. A Senkou Span cross happens when the Senkou Span A and B change positions. This is what we call a Kumho twist. A Kumho twist reflects a change in sentiment from bearish to bullish or from bullish to bearish. Now let's talk about IMI more closely. IMI had been stuck in a trading range since October 2016 until February 2017. The Chico Span was inside this trading range for 5 months. The prices were below the very thick Kumho, which shows a strong resistance. The Kumho was bearish because Senkou Span B was above the Senkou Span A. Here in number 1, a long bullish candlestick appeared. 26 periods ahead, we find the Kumho twist. At this candlestick, price broke above the Tenkan Sen and the Kijun Sen at the same time. The Tenkan Sen crossover above the Kijun Sen also happened. Since the Chico Span is plotted 26 periods back, we find that this same candlestick, the Chico Span, also broke above its range. This candlestick was your trigger. At this point, the bullish crossovers happened. Now the market followed through with strong buying days later as the breakout created a new trading range at higher prices. Notice that as the trading range was being formed, the Chico Span was also ranging because this is merely a reflection of prices moved 26 periods back. Prices were supported by the Kijun-sen line. Since prices were above that line, the medium-term sentiment was bullish. When prices break above the ranges, they often come back and retest the previous resistance as new support. In the same way, the Chico Span creates the boundaries for the trade by also retesting its previous resistance as its new support. The Kumho was bullish because the Senko Span A was above the Senko Span B. Price again broke above the trading range. The Chico Span made another surge upward, showing strong momentum. IMI already established that it is on an uptrend. At this time, IMI is still trending above the Tenkan-sen line, showing strong momentum upward. So as long as all the Ichimoku elements are above the Kumho, including the price, this will still remain on an uptrend. You just have to watch for bearish signals moving forward. So what are these bearish signals? These are the bearish crossovers of price below the Kijun-sen, below the Kumho, or Chico Span crossovers below the price, or perhaps Tenkan-sen crossovers below the Kijun-sen. Now here's an example of a bearish Kumho twist. I would like to show you the Ichimoku signals that warned of this downtrend. AT was also in a trading range. The Chico Span shows the highs and lows of this range. The bearish Ichimoku signals that show the change in sentiment from bullish to bearish are the following. First is the Chico Span crossover below the Kijun-sen. Second is the Tenkan-sen crossover below the Kijun-sen. The third is the price break below the Kijun-sen. Fourth is the Kumho twist 26 periods ahead that warned of the change in sentiment from bullish to bearish. After prices broke out below the Kumho, a new trading range was created. At this point, the previous support now becomes resistance. So what are the Ichimoku signals? First, you have the Tenkan-sen crossovers. If Tenkan-sen crosses above the Kijun-sen, we are bullish. If Tenkan-sen crosses below the Kijun-sen, we are bearish. If the Chico Span crosses above the price, we are bullish. If the Chico Span crosses below the price, we are bearish. Then we have the Kijun-sen crossovers. If price crosses above the Kijun-sen, we are bullish. If price crosses below the Kijun-sen, we are bearish. Another signal is the Kumho breakout. If price breaks above the Kumho, we are bullish. If it breaks below, we are bearish. I'd like to show you examples of Kumho breakouts. Let's go to RCB. RCB broke above the Kumho here. A strong move upward followed. Again, it broke above the Kumho here. There was a gap up above the Kumho, and then a strong uptrend followed. GFC broke above the Kumho recently. It retested that Kumho and was able to stay above the Kumho by the end of the week. Now, if price breaks below the Kumho, we are bearish. Here are examples of price breakouts below the Kumho. Maxes broke below its Senku Span B line. So it broke below its Kumho. It is currently bearish because all elements are below the Kumho. Fill in this land also broke below right here. So do not trade securities which are below the Kumho because they are currently bearish. Now, a Kumho twist signals a change in sentiment. If the Senku Span A is above the Senku Span B, we have a bullish sentiment. However, if the Senku Span B is above the Senku Span A, the sentiment is bearish. I would like to show you some examples of Kumho twists. Blue made the Kumho twist here. An uptrend followed. It made a bearish Kumho twist here. There was a short consolidation period. And then it made another Kumho twist, which resulted in an uptrend. Vista Land. We've here would find the bullish Kumho twist right here. Along with the Kumho twist was a Kumho breakout, and the Chico Span was also able to break above prices. DMC broke above its Kumho. At the same time, we see a bullish Kumho twist right here. The Senku Span A went above the Senku Span B. We know that the top of a bullish Kumho is a Senku Span A, and that is the average of the Tenkan-sen and Kijun-sen within 26 periods. The bottom of a bullish Kumho is a Senku Span B, which is the Kijun and the Tenkan-sen, high and low, divided by 2 over the past 52 periods. So if the Senku Span A is above B, this means that the short-term average is higher than the longer-term average. So you can liken this to a moving average crossover. When using moving averages, a buy signal is generated when the short-term moving average goes above the longer-term moving average. The same principle lies behind bullish Kumho twists. Since the Senku Span A represents the short-term average and the Senku Span B represents the long-term average, then this twist is just like a moving average crossover in principle. Now, if you go back to the charts and we add the moving averages, we will also see that they made bullish crossovers. So let's add the moving averages for DMC. This red line, let's remove the Ichimoku first. This red line is the short-term moving average, and the green line is a longer term moving average. So you can see that at this point, moving averages also made a crossover. This was a bullish crossover. If we add the Ichimoku elements, we find that at the same area, the Kijun Sen and the Tenkan Sen also made bullish crossovers. See this line? They made bullish crossovers at the same area. So those are the basics of Ichimoku, which we discussed last week. Alright, so let's proceed to part 2 of this lesson. Now let's proceed to part 4 of our webinar, using Ichimoku with other tools. We'll talk about trading using multiple time frames. We'll talk about using Ichimoku with other indicators and the Fibonacci ratio. Lesson 1, multiple time frame analysis. This chart is a time frame selection chart. It shows you the types of trade and the time horizon for each type of trade. It also shows you the appropriate chart time frame to use for each trade horizon. Each chart time frame must be confirmed with charts with higher time frames to confirm the bias. So here are examples. If you are a scalper, your trade type is scalping, your time horizon is minutes. Your chart time frame should be 1 minute, but you must confirm this bias with a 30-minute chart. This means that if you're going long using the 1-minute chart, the 30-minute chart must also be bullish. You must not go long on a 1-minute chart if the 30-minute chart is bearish. So there has to be a confluence between time frames. If your trade type is very short and your time horizon is hours, your chart time frame should be the 5 to 10-minute chart. You must confirm this bias in the 5 to 10-minute chart with a 2 to 4 hour chart. Now, if your trade type is short-term, your time horizon is days. Your chart time frame should be hourly, and your bias should be, and you must confirm the bias with a 3-day chart. If your trade type is medium-term, your time horizon is weeks, meaning you want to hold the security for weeks. You should use the daily chart time frame and confirm the bias with a monthly time frame. If you are a swing trader, your time horizon is months. Your chart time frame should be weekly, and you must confirm this bias with a 6-month chart. Now let's illustrate how we could use this chart. We would like to do a short-term trade on Alco. Our time horizon is a few days. So we look into the daily chart for Alco. We use the 3-day candlestick. We find that it is bullish on this 3-day chart because all the elements are above the cloud. Also, the last candlestick was above the Tenkan Sen. So we enter the hourly chart to find the best possible entry. Now here's the hourly chart. Now let's look into the hourly chart. We find that Alco is still bullish. Prices tried to break below the Tenkan Sen line, but it held above the Kijun Sen line. Therefore, using the hourly chart, you would find that the best place to buy is in this area, above the Kijun Sen. The closest it got to the Kijun Sen is at 141. Therefore, there's support in that area. This is also where you find the previous high of the Chico Span. This Chico Span high served as support for prices later on. So this high served as support here. So your entry level is between 141 and 149. This is your price area. This is your price range. Now we have to establish a general rule of the fact that higher time frames have more significance than lower time frames. A one-year chart where each bar signifies 1 year is going to be more significant than a weekly chart. A weekly chart is going to be more significant in its levels than a daily chart. A daily chart is going to have more significant levels than an hourly chart. An hourly chart will have more significant levels than the 5-minute chart, and so on. This is a general rule that we just have to accept because it's been proven over time that market swings or movements in higher time frames will always affect the swings in the lower time frames. That doesn't mean, however, that a swing low on the daily chart means there won't be any swing highs on the hourly charts. But the daily swings will affect those hourly swings. That's why we like to trade along with a higher time frame. Now we only use the higher time frame to give us indications on what will be happening in the market on the lesser time frames and to confirm our bias. Now, if you trade lower time frames against higher time frames, then your profit potential is probably going to be lower and your risk will also be higher. Now let's take, for example, this chart of the USD-JPY currency pair. So you find that the security is bearish and the trend is sideways to down. Price had already broken below the Kumho. You have to go short on this trade, and then you could use the Chico Span support levels as possible bounce points. If you enter a short position, your stop loss would be the Tenkan-sen line above. Your first possible profit target would be bounce level 1. This is a bounce point because if you look to the left, you will find the Chico Span and the Senkou Span in the same level. Now, if price fails to bounce off that point, look to the next bounce point. At bounce level 2, you look to the left again and you also find the Chico Span range and the Senkou Span B in the same level. So you just adjust your stop loss point as it goes lower. This is how you could trade this currency pair using the daily time frame. Now let's look into the lower time frame, the 5-minute chart, also of the USD-JPY currency pair. You would find that on the 5-minute chart, the trend is the complete opposite. The trend on the 5-minute chart is upward, while the trend on the daily chart is downward. So would you do a short trade or a long trade on this one? You would of course go long because you must always trade your time frame. You must not mix time frames. You see that the price bounced off the Kumho, so you enter a long position here. Because price is at the Kumho top or the Senkou Span A level. Then you put your stop loss below the Senkou Span B. Your target 1 or profit take level 1 is the Kijun Sen because that is now resistance. Your target 2 or second profit take level is at the Chico Span top range. Now, previous trade on the USD JPY was a 5-minute trade that is on an uptrend, while the daily chart is on a downtrend. So when we traded the 5-minute chart, we were actually trading against the general trend. Now, these were the small bounces that you find in the 5-minute chart. While you may be able to profit from the swings or from the short upward corrections within the general downtrend, your risk is higher because you are trading against the general trend. Your profit potential is also limited because you're only taking advantage of swings against the trend. So when you go long into this USD JPY trade, you are actually getting into a high risk, low reward setup. Your better option is to trade with the general trend. If the general trend is down, then we take a look at the 5-minute chart to see the highs and the lows, and we will pick a specific entry. Using the candlesticks, Kijun-sen and Tenkan-sen, and those divergences, we will be able to find a specific entry. So reminder, never mix time frames. If you do decide to take the smaller time frame against the general trend, you have to know the risks. And if you enter the market using signals from the 5-minute chart, you should also exit the market with signals from the 5-minute chart. Never mix time frames. Do not enter using signals from the 5-minute chart and then exit using the signals from the daily charts. This is just wrong and will cause you to lose money. So it all has to do with the theory of multi-time frame confluence. If your higher time frame has a bullish bias, for example, the monthly chart, and the lower time frame, say the weekly chart and the daily charts have bullish biases, then you have multi-time frame confluence. You're trying to find a confluence between a higher time frame and the lower time frame to give you the best possible entry. So this is how we pick our entries, where it reduces our risk and maximizes our potential for every trade. We don't want to be contradicting the higher time frame and the lower time frame unless we understand the risks. We do not want to be contradicting the higher time frame by trading against it in the lower time frame unless we really understand the risks, and that is what we want to do anyway, and that is our strategy to begin with. Now I'd like to show you examples of securities which have multi-time frame confluences. Now you want to hold PNX for 3 weeks as a position trade. So you look at the monthly chart. You want to find the bias of the higher time frame. So what can you conclude from this monthly chart? Phoenix Petroleum's prices are above the Kumho. There was already a Kumho breakout. There's a Chico Span breakout, a Tenkan-sen crossover, a Kijun-sen crossover. Therefore, this chart is bullish on the monthly time frame. Now we look at the weekly chart. It is also bullish on the weekly chart. It's also bullish. Now we look at the daily chart. All Ichimoku elements are also above the Kumho in the daily chart. Therefore, what we have here for PNX is a multiple time frame confluence. So a confluence of time frames is the ideal situation. Now let's look at another chart. Let's check out MAC. First, let's go to the monthly time frame. The monthly time frame shows that all Ichimoku elements are also above the Kumho, therefore it's bullish. Weekly time frame, we see the same thing. All elements are above the Kumho. In the daily time frame, all elements are also above the Kumho, therefore it's bullish. Now, since the general trend is bullish, you could enter the market at lower time frames like the daily chart and have higher chances of the uptrend continuing because the bigger trend is bullish. Note, however, that charts like this, like PNX and MAC, are hard to find. In other situations where the time frames do not align, for example, if the monthly chart is bearish but the daily and weekly time frames are bullish, then you can still trade that. For example, you only want to trade Bloom, but you want to trade it for a position trade. Let's check out the daily chart. The daily chart is bullish. The price is above the Kumho. The weekly chart is bullish. The price and other Ichimoku elements are also above the Kumho. So on the daily chart, you'd be buying every time it dips towards the Kijun Sen, holding that until it breaks below. So you would be buying this at this level because it broke above the Kumho, and Chico Span also broke above the prices. There were also Tenkan and Kijun Sen crossovers. And then from here, prices trended sideways, but still above the Kijun Sen. It broke below Kijun Sen. You probably would have cut here, but you would have bought back once price went above the Kijun Sen once again and the Tenkan Sen once again. Now, the weekly and daily charts show that all prices are above the Kumho. However, let's look into the monthly chart. What do we find in the monthly chart? The monthly chart is bearish because the elements are below the Kumho. Now, if you're only trading this, for example, from a position trader standpoint, you can still trade this using the daily and the weekly charts. At area, we will find the Senku Span A. This is your immediate resistance in the monthly chart. So this is at 1216. So if you're trading this, you bought this using the daily chart, and you confirm that using the weekly chart, this monthly chart only tells you that at 1216, you will find a strong resistance. While you continue to hold Bloom and trade it because it's above the Kijun Sen on daily and weekly time frames, at the monthly time frame, it's also above the Kijun Sen. However, you know that you will meet resistance at 1216 at the Senku Span A area. So, because it's very hard to find charts which have confluences in the daily, weekly, and monthly time frames, therefore, if you use the daily and weekly time frames, you could still trade the market. Just be mindful of the resistances at the monthly time frame. I'd like to show you an example. You probably, if you had traded EDC, you would see that it is also trending above the Kijun Sen line. This is the daily chart. This is the weekly chart. It is also trending above the Kijun and the Tenkan-sen line. If you look at the monthly chart, you would find that it hit resistance at the Senkou Span B. This month, it couldn't get above the Senkou Span B because it was a strong monthly resistance. So while it seems all well and good in the daily and weekly charts, you wouldn't find the resistance here, but you would find the resistance in the monthly chart. So you have to have that in mind. So the supports and the resistances in higher time frames are stronger than the supports and resistances in lower time frames. Now I'd like to show you a chart that is bearish on all time frames. This is MG. It is below all Ichimoku elements on the daily time frame. It is below all Ichimoku elements on the weekly time frame. It is below all Ichimoku elements on the monthly time frame. So this is bearish on all time frames. If we were allowed to short this market, MG would be a good shorting candidate. Lesson 2 of part 4 is about using Ichimoku and other indicators. For this lesson, we will use the ultimate oscillator with Ichimoku. You will find this indicator or this oscillator in your call charts. You may also use other indicators like the RSI or the stochastics if the ultimate oscillator is not provided by your broker's charts. I choose the ultimate oscillator because unlike the RSI or other indicators, the ultimate oscillator captures momentum on all different time frames. What happens with other oscillators like the RSI is that when a strong move happens, they start forming the bearish divergences as the move is happening because they are stuck in one time frame. The ultimate oscillator tries to avoid or correct this problem by incorporating longer time frames into the basic formula. So a buy signal is based on a bullish divergence, while a sell signal is based on a bearish divergence. So we will use divergences in the ultimate oscillator along with the Ichimoku to get a stronger conviction on our entries and exits. So let's review what divergences are. When a technical indicator disagrees or moves in the opposite direction as the price action, it creates powerful technical signals called divergences. There are two kinds of divergences, regular and hidden. There are also two biases for divergences, bullish and bearish. Divergences provide reversal or continuation signals. So what's the difference between a regular divergence and a hidden divergence? Regular divergences are signals for possible reversals, while hidden divergences signal trend continuation. Let's discuss regular divergences first. Regular divergences signal trend reversal. Now let's talk about regular bullish divergences. A regular bullish divergence is when the oscillator is making higher lows while the price itself is making lower lows. Now, if the reversal brought about by the bullish divergence is confirmed by Ichimoku signals on a chart, then we can place a buy order on the position. I will show you how we could use bullish divergence with an Ichimoku chart. So this is a regular bullish divergence because price makes lower lows and the indicator makes higher lows. EDC had been on a downtrend for 1 month until December 2016. The downtrend was signaled by a Kumho twist in November 2016. All Ichimoku elements are below the Kumho. Price had been trending below the Kijun-sen line, and that served as resistance. There have been attempts for EDC to break above this Kijun-sen line, but these attempts failed. Here's the first attempt. It tried to cross above the Tenkan and Kijun-sen line, but formed a double top at the Tenkan-sen line. So here was a double top in the candlestick. Now here was the second attempt. Traders may have been faked out by this move because price actually went above the Kijun-sen and stayed there for a few days. But if you look at where the Chico Span was 26 periods back when this crossover happened, you would know that this breakout was going to fail. First of all, you must recognize that the bigger trend always wins. The general trend in this chart is down, so that is the stronger trend. Price could try to make small bounces in between. It could even try to break above its resistance. But if the volume is not strong enough to take out all the sellers, that bounce is likely to fail. Like the bigger trend is more likely to win over the shorter trend. So as an Ichimoku trader, what was the signal that number 2 was going to fail? First reason was because the Chico Span could not get above prices. This was the Chico Span, and it was hindered by prices. Second, there was no bullish future ahead. There was no Kumho twist in the future. If we count 26 periods ahead of the candlestick, the Kumho twist was not there yet. 26 periods forward, the Kumho was still red. So we just assume that this market will continue to go down. So how do we spot the reversal? We could use the Kumho twist. We could wait for the Senkou Span A to get above the Senkou Span B. But it would be a big probability booster if you find divergences. Divergences could warn us of a change in trend. Well, it will not work all the time, but at least it increases your probability for a better trade. So to find these divergences, we use the ultimate oscillator. The ultimate oscillator requires 3 steps for a buy signal. First, there has to be a bullish divergence between the ultimate oscillator and the price. This means that price forms a lower low while the oscillator forms a higher low. We need the higher low in the oscillator because it shows that the momentum to the downside is getting weaker. Now second, the low of the bullish divergence should be below 30. So here's the line that marks the 30 level of the ultimate oscillator. We see that the low of the divergence is already below 30. This is to ensure that prices are at least oversold or is at an extreme condition. The third condition is that the oscillator rises above the high of the bullish divergence. Now this was the low of the bullish divergence, and this is the high of the divergence. The ultimate oscillator must be able to move higher from that point. Now we have established that we have a powerful bullish divergence that may signal reversal from the downtrend to an uptrend. Now we look at the Ichimoku indicators. After that divergence was formed, we see the following bullish signals. We have the Tenkan-sen crossover. We have the price crossover above the Kijun-sen. We find a Kumho breakout. We find a Chico Span crossover above the Kumho. We also find a Kumho twist. This Kumho twist signaled the change of sentiment from bearish to bullish because the Senko Span A moved above the Senko Span B. From then on, EDC started to reverse and price trended from a low of 489 to a high of 612. It hit a strong resistance line and is currently consolidating near this area. Now, this level is a strong resistance level. However, EDC had been trying to break that. Let's see what happens in the following days. It might be able to break that finally. Now, granting that we have already found the divergence, and we already found some bullish Ichimoku elements, do we just buy at any price? Can you enter anywhere as long as it is still bullish? What we want as traders is to be able to maximize our profits and minimize our risks. So we must find the lowest possible entry for the time period and sell at the highest possible price. There are three things we should consider when making an entry. First, the level. Levels are supports and resistances. Support is the best level to buy because the risk is low. The resistance is the best place to sell because the upside risk is also low. Divergences are present at support levels, then it would make our entry more favorable. Now, the signal is what tells you that it is about time to enter the market. For example, if you see several candlesticks testing the support level many times and bouncing off that support level, it tells you that the support holds and this could be a good bounce point. The trigger is what confirms your bias. For example, after price retests support several times, it bounces with a bullish engulfing candlestick that breaks above the previous range. Then that is a trigger to buy. So the trigger is your confirmation. So let's look at an example. Let's plot the divergence first. So the level is the area which is your buy point. This level is the top Kumho, which is a support level. You find that price bounced off that level. That level is a possible buy area. The signal is the price bounce above the Kumho top. The candlestick served to retest the previous resistance as the new support line, and that support line was able to hold. The trigger is the bounce from the support with a long green candlestick and the break above the Tenkan-sen line. So your trigger to buy is the fact that it created a long green candlestick and broke above the Tenkan-sen line. So what did we say about uptrends? Each uptrend starts with a Kumho breakout. Therefore, as long as price is still below the Kumho, it is still bearish. The breakout above the Kumho and the successful retest as support is a good entry point. Now let's talk about regular bearish divergences. This is the opposite of a bullish divergence. A bearish divergence signals the change in trend from an uptrend to a downtrend. Now, when the price trends up while the indicator trends down, we have a regular bearish divergence. A regular bearish divergence tells you that the market is about to reverse from uptrend to downtrend. If the bearish reversal signaled by the bearish divergence is confirmed by Ichimoku signals on a chart, then we can place a sell order on that position. Now, let's take a look at the chart of Ayala Corporation. AC is on an uptrend after the bullish Kumho twist and Kumho breakout. Price had been trending above the Kijun-sen line, and that line served as a support. So there's an uptrend because price is supported at the Kijun-sen line. There have been attempts to break below this Kijun-sen line, but these failed. Here's the first attempt. Price was able to break below the Kijun-sen line, but bounced on top of the Kumho with a bullish engulfing candlestick. Now here's the second attempt. It tried to cross below the Kijun-sen line, but the candlestick formed a double bottom. Now there was a bounce at the Kijun-sen line. Price trended above the Kijun-sen line and bounced many times. In attempt number 3, price tried to break below the Kijun-sen line, but this time it succeeded. This was a bearish signal. If you look at where the Chico Span was 26 periods back, when this crossover happened, you would also get a bearish confirmation because the Chico Span was able to break below prices. Now we need a probability booster. Apart from Ichimoku signals, divergences could also increase the probability that the trend will indeed change. If there's a strong case for bearishness, then we need to sell our position. Now, there are 3 steps to a sell signal. First is a bearish divergence. This means that the price is making higher highs, while the ultimate oscillator forms lower highs. Since the ultimate oscillator is making lower high, then it shows that the momentum is getting weaker. We find that bearish divergence here. Second, the high of the bearish divergence should be above 70. This makes sure that prices are somewhat overbought or at extreme conditions. In our chart, the oscillator is already too high. Third, the oscillator falls below the low of the bearish divergence. This confirms a reversal. Now, with the presence of the bearish divergence, we increase the probability that this attempt number 3 will be able to succeed and start a break below the Kumho. So you can see the market moving higher, but from that point, the oscillator is moving lower. Now, along with the bearish divergence, we also see signals from the candlesticks that there was also a double top. Aside from the Chico Span, there was also a bearish Kumho twist in the future. There was also a Tenkan-sen and a Kijun-sen crossover. And finally, there was a price breakout below the Kumho and a downtrend followed. Now, the bearish divergence helps boost our conviction of a reversal to the downside, along with the bearish Kumho twist and the other bearish Ichimoku elements. So if you are selling this market short, do you sell at any point since you are expecting a downtrend anyway? So the answer is no. You need to identify the point at which you have less risk and higher chances of success. So what are the level, the signal, and the trigger? So here's your bearish divergence. Then you find the level, the signal, and the trigger. The level is the resistance level. The Kijun-sen line is the resistance line. Thus, is the best level to sell because it is below the Kumho and therefore bearish. It is also the level which will act as resistance to any bounce. The signal is the set of bearish candlesticks that failed to break the Kijun-sen to the upside. So this is that set of candlesticks which failed to break the Kijun-sen. Your trigger is the long red candlestick that confirmed strong resistance or strong selling at the Kijun-sen. So if you are shorting this market, you could hold on to your position until you find a reversal signal. Here's another example. The New Zealand dollar and Japanese yen currency pair. First, we find a regular bullish divergence signaling the reversal. Then there was a Kumho breakout, the Tenkan-sen crossover, and a Kijun-sen crossover, and a Chico Span breakout. Then prices started to trend upward. Now we find the first bearish divergence. Now one made multiple bearish divergences. This was the first bearish divergence. There was another bearish divergence. So this was the second. You would find that at the second bearish divergence, the price also made a double top. This was a bearish chart pattern as well. So this increases the likelihood that the price will drop from these highs. Bearish Ichimoku signals also appeared along with the bearish divergence. There was a Chico Span, Tenkan-sen, and Kijun-sen bearish crossover, and a Kumho twist. The chances are high that a reversal will happen, and this was confirmed by the Kumho breakout to the downside. Prices started to trend downward. So with the divergence as a probability booster, we are able to assess with high certainty what the direction of the market will be. So we have already discussed regular divergences. Let's talk about hidden divergences. Hidden divergences signal continuation of a trend. So if your existing trend is bullish, a bullish hidden divergence tells you that the upside will continue. If your existing trend is bearish, a bearish hidden divergence tells you that the downtrend will continue. These hidden divergences happen at corrections or consolidation points within the uptrend or the downtrend. Hidden divergences are the trend follower's best friend. So here's that bullish hidden divergence. Price is making higher lows and the oscillator is making lower lows. Hidden divergences help boost the probability that the current trend will continue. If the hidden divergence happens at a support or turning point, then we have a level. If this level is confirmed by a number of candlesticks bouncing off the same support, then we have a signal. If we find the bullish candlestick at the bounce from support or some bullish crossovers occurring at that area, then we have a trigger. So here's an example using Globe Telecoms or GLOW. When price is on a strong uptrend, it likes to follow the Tenkan-sen. At the start of the uptrend, we find that the Tenkan-sen crosses above the Kijun-sen. This is a bullish signal, and this bullishness is confirmed by a price break above the Kumho. Here's that price break. 26 periods ahead, there was also a bullish Kumho twist. Now, as price moves within a trend, you find that the price made a small triangle or a pennant pattern. You would like to add to your current position or enter a new one if you're not able to buy on the initial breakout. So you want to enter at the best possible price. You also want to enter at the best possible time. These are two things that a trader holds valuable: price and time. So you do not want to buy in the position only to end up waiting for weeks for it to move. You also do not want to buy at prices where you will end up cutting huge losses because you did not buy at the proper support level. So how do we enter? You buy at the Kijun-sen level because this is where the price had been bouncing off. This is your level. Price bounces off the same support line twice and then makes a doji. This is your signal. Now, price breaks out of consolidation and crosses above the doji resistance. This is your trigger, the violation of the indecision by a green candlestick above the doji. Now, there's an additional probability booster that we could use to know if prices will continue on its uptrend. Now, at this point, we see prices making higher lows and the oscillator making lower lows. This is what we call a bullish hidden divergence. There's disagreement between the price and the oscillator. The hidden bullish divergence adds conviction to our entry. Now, after the trigger, price continued to trend up using the Kijun-sen as its support line. And then price consolidated once again, and we find a hidden bullish divergence once again. So we re-enter or add positions and just continue to hold on until we find a bearish signal. Now let's talk about hidden bearish divergences. A hidden bearish divergence is found in a downtrend. Price makes a lower high, but the oscillator is making a higher high. A hidden bearish divergence signals that the price will continue with its downtrend. Here is how we illustrate a hidden bearish divergence. When you're shorting a market, perhaps in the future when we are allowed to short sell the local stock market, or when you're trading other markets like Forex, commodities, the US market, the Hong Kong market, etc., you always want to trade with a trend. You also want to maximize profits. When the market is on a downtrend, look for hidden bearish divergences. Hidden bearish divergences let you ride the trend longer despite consolidations in between. Consolidations or corrections might shake you out or cause you to sell your position, but if you are able to spot hidden divergences, you will be able to hold on longer. Here's an example of a hidden bearish divergence. The major trend is a downtrend. Like we said earlier, when Ichimoku elements are below the Kumho, it is on a strong downtrend. Now, until we find signals like the Kumho twist or crossovers or Chico Span breakouts, we assume that this trend will continue to go down. On this chart, price makes lower highs, while the oscillator makes higher highs. There are bearish hidden divergences, which signal the continuation of the downtrend. We see multiple hidden bearish divergences in this chart. So if you are short on a position that looks like this, just keep holding until you see a sign of reversal. From the first bearish divergence, we already see that the Ichimoku signals are also bearish. First, there was a Chico Span crossover. And then there was a Tenkan-sen and Kijun-sen crossover. There was also a bearish Kumho twist. It was followed by a bearish Kumho breakout. So what are your level, your signal, and your trigger? Your level is the Tenkan-sen resistance zone. Your signal is the rejection at the resistance. Your trigger is the Kumho break. So price will continue to trend down. However, at the bottom of the trend, you will find that price stopped dropping. Price made same level lows, while the oscillator made higher lows. There is a regular bullish divergence. This signals a change in sentiment from bearish to bullish. And then Ichimoku elements all showed bullish signals. There was a Kijun-sen Tenkan-sen crossover. There was a Kumho breakout and a Chico Span crossover. So the reversal in trend, signaled by the regular bullish divergence, were validated by the bullish Ichimoku elements that followed. And then price started to trend up. Now let's look at some examples of divergences. So you could use the same divergences on the Forex market. Here's the Euro FX USD. We find multiple bullish divergences that signals reversals of trend from bearish to bullish. Your level is a support zone. The support zone was found on the Kijun-sen line. The signal is the rejection at the support level. Your trigger is a long green candlestick that followed these bounces. Then we find the hidden bullish divergence to signal trend continuation. Right at the top, we could find a bearish divergence, and we also find bearish Ichimoku signals. Therefore, we assume that the market will drop and it's time to enter a short position. So these are bearish Ichimoku elements showing the change in direction from uptrend to downtrend. These elements confirm the signals given by the bearish divergences. Now let's go to lesson 3, Ichimoku and the Fibonacci ratio. Fibonacci retracement was based on the Fibonacci sequence. It is a method of technical analysis that determines support and resistance levels. Now, Fibonacci retracement is based on the idea that markets will retrace a predictable portion of the move, after which they will continue to move in the original direction. Now, the Fibonacci retracement uses horizontal lines to indicate areas of support and resistances. It is calculated by locating the high and low of the chart. It is measured from the high of the chart to the low of the chart or vice versa for reverse Fibonacci retracements. After a significant movement up or down, the new support and resistance levels are often at or near these lines. This chart of nickel shows you the price range from June 2016. I used that level as the swing low and the November 26th level as a swing high. So I plotted the Fibonacci levels from the low to the high. So after nickel made a run from its low of 4 pesos to its peak near 850, price dropped and it is currently at the 61.8% Fibonacci level. On its way down, it made several bounces. Bounce number 1 was a 23.6% Fibonacci ratio. Bounce number 2 was at the 50% level. Bounce number 3 was at the 61.8% Fibonacci level. Now this was the golden ratio. Now if the market is to remain bullish, this has to make a strong bounce from here. If this bounce fails, we are looking at the 78.6% Fibonacci level next. Fibonacci levels are supports and resistance points. So when price bounces at Fibo levels, it uses the higher Fibo level as its resistance. If broken as support, it becomes resistance. Now we could combine these levels of supports and resistances with the supports and resistances that we find on Ichimoku charts for added probability boost. So we find confluences or common areas of support between Ichimoku elements and Fibonacci ratios or Fibonacci levels. It is a stronger support or resistance level. That level should be used in making entry and exit points. Now here's how we combine Ichimoku and Fibonacci retracement to find confluences in support and resistances. So if you bought some shares of X right here at the low near 7, and you are looking for a price where you could sell your shares, so you will plot the areas where the price of X might encounter resistance. Previously, we discussed how Chico Span marks supports and resistances. We also know that previous supports become resistances. So we will plot this line. The first resistance was near the 1030 level. This level was marked by the Chico Span previously as a resistance level because it was support in October 2016. At the same time, that is the level where the Senkou Span A is located. If price breaks above this level, the next resistance is at the 12 peso area. At that area, you would also find the Chico Span gravitating within that range in September 2016. The Senko Span B is also located in the same range. The Senko Span B is the long-term resistance line because it computes for the highs and lows over the last 52 periods, and it is often a flat line. Thus, this resistance 2, is a strong resistance. Now, our third resistance level is at the 14 area, or the 1450 area. Again, you would find the Chico Span range to the left, where it was the support level in August 2016. At the same time, that is the level where the Senko Span A is located. If price breaks above this level, the next resistance is near the 1650 area. This is resistance 4. There was a Chico Span range in July 2016. The Senko Span B is also located at that level. Now this next slide shows the same chart but including the Fibonacci levels. This was plotted in reverse from the low of 7 to the high of 20. Note that I plotted the candles from body to body. When plotting Fibonacci levels, you have to be consistent. Either you plot from the body of the candle high to the body of the candle low, or you plot from the wick of the high to the wick of the low. So do not mix the body and the wick. So here's that chart. It shows you supports and resistances using Fibonacci levels. Resistance 1 is near the 10 peso area at 10.07. This is 23.6% Fibonacci level. Remember that we said that supports and resistances are not exact levels but areas. The Senko Span A is located in the same zone. This approximates the resistance level 1 in the previous chart. Now, resistance 2 in this chart is located at the 38.2% level at 12 pesos. This is also where the Senko Span B is located. This was also the resistance from the previous chart. Now, resistance 3 is at 15 pesos, or the 61.8% Fibonacci level. This is located in the same area as the Senko Span identified in the previous chart at 1450. Now, resistance 4 was at 17 pesos at the 78.6% Fibonacci level. Again, this was at the same area as Senko Span B at 1650 in the previous chart, where we only used Ichimoku elements to find supports and resistances. So we know that the Ichimoku system also lines up with the Fibonacci ratio numbers in a chart. So when you look at retracements, you can look at these flat tops and bottoms, or the Kumho or the Senko Spans A and B. And you know that it's probably lining up with a 50% or a 61.8% retracement level or the 38.2% level. So the Fibonacci levels are also good levels for you to look at on retracement. If the Fibonacci level lines up with the Senko Spans A or B, then consider that a good support or resistance level. Now let's look at some trade examples. So let's look at the weekly chart of MPI. I plotted reverse Fibonacci levels on the MPI weekly chart, and I find that there's a confluence of resistances between the Tenkan-sen, the Kijun-sen, and the 50% Fibonacci level at 544. Sorry, at 644. After that, the next confluence of resistances can be found at the Chico Span A and the 78.6% Fibonacci retracement level at 672. So these are strong resistances. It already broke above the first strong resistance of 644. Now it will be faced with 672, which is also a confluence between 78.6% Fibonacci level and the Chico Span A. So basically the levels line up and you add the Fibos for conviction to find confluence. So while you can use the Ichimoku system alone, added confirmation from the Fibonacci as a level of entry and exit would also add to your conviction. Just follow the rules and be patient and wait for the setups, and you will be profitable. Now we can look at the higher time frames to find direction and or target prices, and drill down to lower time frames to find entry and exit signals. Now let's look at the chart of IS. Now I would like to plot the Fibonacci levels for IS. This was the bottom where we find the hammer and then the long candlestick that followed. So we'll start the retracement from there and move it up to that high. So what do we find here? Upon the bounce, price hit the 38.2% Fibonacci level. This was at 372. You would find that on the weekly chart, this is also where Tenkan-sen is located. So it was unable to break above that Tenkan-sen level. There was a confluence between Tenkan-sen and 38.2% Fibonacci level at 37. Now let's go to the monthly chart. This monthly chart shows that price also resisted at the 50% level, which was also the Kijun-sen in the monthly chart. So we find confluences between Ichimoku and Fibonacci levels there. Here's another example. We use the monthly chart to find the general direction of any bounce that uses Ichimoku, using Ichimoku trading system. So for example, for MRC bounced strongly. Now let's look at the monthly chart to see where possible resistances are. So here is a possible resistance for MRC. This is the Kumho top or the Chico Span B. Now let's do a reverse Fibonacci level on this. At the Chico Span B at 53, this is also where you find the 50% Fibonacci level. So there's a confluence of resistances at this level. So it could reach until the 53 area. That is where you find more resistances or a confluence of resistances. Let's look at the lower time frames if there are also resistances at lower areas. Is at 42, 38.2% Fibonacci resistance. This area, 42, you would also find the Chico Span resistance in the weekly chart. This was the Chico Span resistance, this area right here, where you see that the Chico Span bounced this area right here. I'd like to check out IMI. Now, IMI is also bullish on all time frames, daily, weekly, and monthly. Now, I'd like to do a reverse Fibonacci on IMI to see where Ichimoku elements meet Fibonacci. So again, at the bounce, we see that there is a common resistance at the 716 area, which is the Kijun-sen. Let's look at Annie. Now this was Annie on its bounce. Now let's plot reverse Fibonacci. Now there's a common resistance at the 382 area previously, where you also find the Tenkan-sen and Kijun-sen. Now price broke above that, and now that same area serves as support on the monthly chart. Look at this area here. This area. There are several candlesticks at that area because that is a strong support. A confluence between 23.6 Fibo and the Kijun-sen and Tenkan-sen monthly. So right now, the Annie is above the 38.2% level. There's no confluence of Ichimoku at that level. The next confluence will be found at 688 to 7 area, where we find the Chico Span B and also the 50% Fibonacci right here. So if you look at the monthly chart, you'll find that the target for the initial target for this run is at 688, which is the Chico Span B. But if it surpasses that, it could go up to as high as 826. Cebu Pacific. Now from this low to this high, let's go for the weekly charts. We do a reverse Fibonacci here. What do we find? There's a common resistance at the Kumho top at 107.5 and the 50% Fibonacci level. This is a confluence right here. Now let's take a closer look at AGI. AGI is currently bullish. First, there was a Kumho twist. Second, there was a Kumho breakout. Third, there was a Chico Span crossover. Fourth, there was a Kijun-sen crossover. Fifth, there was also a Tenkan-sen crossover above the Kijun-sen. All these elements show bullishness in the AGI chart. The Tenkan-sen crossover and the Kijun-sen crossover happened below the Kumho. Therefore, they are weak bullish signals. However, AGI was still able to break out strongly above the Kumho. It is currently trending above the Tenkan-sen line. Here's another case. We have PNX. PNX is trending strongly because it was able to meet all the conditions for a successful breakout. First, there was a Tenkan-sen crossover. Second, there was a Kijun-sen crossover. Third, there was a Chico Span crossover. Fourth, there was a Kumho breakout. Fifth, there was a Kumho twist 26 periods ahead. That twist actually corresponds to this candle at number 4. Now, PNX was stuck in a range for a few months from February to March, and then it broke out along with the Chico Span. Now it formed another trading range and made another breakout just recently. So PNX has a very bullish price action because it had been breaking its recent highs and it's currently trending above its Tenkan-sen line. Here's another case. Boulevard Holdings. Boulevard Holdings already made a Kumho twist and is now trending above the Kumho. It did a Kumho breakout. There was also a Chico Span crossover. There was a Kijun-sen crossover and a Tenkan-sen crossover. Currently, Boulevard Holdings is still bullish because all the elements are above the Kumho. However, it is still consolidating, so we have to wait when Boulevard Holdings could start to trend. So right now, since the market is still ranging, we can't use the Tenkan and Kijun-sen because the market is still in a range. The important thing to take away from this chart is that all the elements are above the Kumho and there was already a Kumho twist. Therefore, the change in sentiment is from bearish to bullish. Now, the Chico Span crossover happened while the price was inside the Kumho. This was a neutral bullish signal. However, there are strong bullish signals above the Kumho. One of these is the Kijun-sen crossover and the Tenkan-sen crossover, and also the Kumho breakout. So thank you very much for attending today's webinar. Thank you for supporting me at Bukaka. Please do not hesitate to send me any questions if you have any. Email me or send me a message on Facebook. So thank you very much and goodbye.